Hi, folks. Mark Weissy here with Rick Martin from Fortress Federation. And in this video, we're going to go through a topic that's come up a number of times in my discussions with other investors, new investors, or prospectively new investors about where should I start? Should I start in syndications, joint ventures? What's the difference between them? How do you defer between the two? And how do you make a choice ultimately in which vehicle to use to invest in real estate? So first, I'll start with just a brief overview. And before I even get to that, I just want to add a disclaimer that neither of us are attorneys, at least as far as I can tell. Rick is not an attorney. And so this is not going to be legal advice. This is going to be based on our experiences with operating. Both of us have done syndications. Both of us have done joint ventures. And actually, both of us are involved with a single joint venture together. And so we have a ton of experience in this space and pooling resource and in real estate investing. And that's really what this topic is about, is how to go about that, doing it in a legal and proper way. So I'll start off with a high-level definition of syndications. And typically, syndications are just a way to pool resources for larger projects requiring substantial capital. Whereas joint ventures are a little bit more flexible. They're often used more so on the partnership side between 2, 3, 4 investors or entities, putting their capital together, putting their energy together in order to make a successful investment. So we'll do a deep dive into syndications and joint ventures now, and some of the advantages and disadvantages of each. So first of all, like I said, syndications involve pooling capital from multiple investors in a real estate project. One or more of those sponsors are going to take on the management and operations of that investment, while the investors in that investment are more passive. So they don't take an active role. They're just basically responsible for providing the capital, and then they receive returns on that capital, but really have no active role in the ongoing management. Whereas the sponsors are responsible for sourcing the deal, managing, financing, executing the deal, sometimes signing on a loan, really everything that goes into the sweat equity of making it a successful investment. As far as the advantages go, on the syndication side, you're getting diversification because it allows you to participate in a larger number of deals than you might otherwise be able to afford on your own. Also, you could be geographically diversified or diversified across a number of different operating partners or sponsors. You could be investing in one deal in the Midwest and then the next day investing in the West Coast and so on and so forth. You can also diversify across asset classes. There are syndications for multifamily, for retail, storage centers, you name it, and you can syndicate it. Another advantage is that it's a passive investment. Investors don't need to be involved with the day-to-day operations of running the asset. They just have to get the monthly or sometimes quarterly updates and cash flow, get their end of year K1s and file those with their tax returns. And that's the extent of their involvement. They have the access to the sponsor, but they don't have to be involved with the day-to-day of overseeing property management or doing anything like that. And then thirdly, with a syndication, you get professional management. You're getting the expertise of sponsors with a large background and track record in investing and bringing about successful outcomes in real estate. So it's not just you, and as you're starting off, that may be a real benefit because you're going to make a ton of mistakes. We all make a ton of mistakes in investing in real estate. And so getting access to the pros and investing alongside them, I think is a really good way to start. Anything you want to add there, Rick?
Well, I think we should maybe back up and unpack some of that stuff that you talked about. As you're talking, I'm thinking of just some of the things that people may not even realize that are different about each. Like a point that you made was that the sponsor team is responsible for people's capital, and that's a big difference. Joint venture, you come in as equal partners, everybody brings their own capital, and you don't have that weight on your shoulders of being the steward of other people's capital. I think that's a huge difference right there. People think, this is great, let's do real estate with other people's money. That's a little scary. That's very scary. It will keep you up at night. And to coin a phrase from Rod Cleef, ask me how I know. I mean, if things start to dip in performance, it gets magnified if it's a syndication as opposed to a JV. Hey, if it's a JV, it's not good. That's too bad, but it's your money. So there is a lot of responsibility when you take on a syndication, and people jumping into the syndication space ought to maybe do a JV prior to, maybe a JV or two prior to being in charge of and responsible for other people's money. That was just as you were speaking, I just thought about that. How do you feel about that one?
That's huge. Yeah, I think from the point of view of the sponsor, like you said, you're taking on a fiduciary responsibility to other people. And so you don't want to necessarily rush into that. You definitely want to have experience before you get into, at least from the active side, a syndication. But on the passive side, I think a syndication is a really great way to maybe dip your toes into bigger deals. Maybe you have a little bit of experience with real estate and you want to see how bigger deals are done. I know that's the way that I got into doing larger deals. Was I basically was earning while I was learning. So I was invested with an operator who I had a relationship with and had vetted, but also who I had a friendship with, that I could call him up anytime I had a question about, hey, how did you do this? Or how do you approach this? And so I think that's a really good way for LPs to start on the passive side.
Yeah, I agree. And it's up to the passive investor how active they want to be, how much behind the curtain they want to take a peek. Hey, I have some passive investors that they put me to the test. They ask a lot of questions, as they should. They have a lot of money involved. So it's really up to the passive investor. And by definition, a passive investor wants to be kind of a set it and forget it type of investor. So more often than not, you're not going to get a ton of people, banging on your door in the middle of the night. It's not as if you're like the property manager of a building. You talked about the structure. It's definitely it's more complex, right? It's this org chart as compared to, we could talk a little bit about our JV together. And also, by the way, I don't know how you felt, but attending conferences or meetups, very beginning, if you could think back then, like, a joint venture. What is a joint venture? It's kind of a fancy term for a partnership, but it's a different kind of partnership. The stuff that we talked about, all equal parts. And Mark and I, we have essentially equal partnership, kind of 4 partners, basically a quarter each. And we all have different responsibilities. Some are more defined than others. In fact, I've had some issues finding what's my role in that partnership. That's something that has to be defined, and because you don't want responsibilities piling up on any one individual. It just so happens that in that partnership, one of our partners took on the role of asset manager and put in more sweat equity than actual capital or equity, and that's how he's earning his stripes in that deal.
Yeah, I think that's a big part of this whole thing too, is usually syndications are pretty well defined, being that you have to create a lot of documentation, a lot of legal work goes into the syndications, and it's a very direct line that's known. This is the passive group. These are the people that are going to be steward of the overall investment, and then these are passive investors. Whereas when you get into the JV, as we'll see when we cover that section, it's a little bit more flexible. You can really make it according to the different responsibilities or competencies of the people that are in the actual partnership. And it can also change with a joint venture, whereas with a syndication, it's really pretty well defined there.
Yeah, I agree.
We were talking about disadvantages next of syndications. So the first disadvantage is the fact that you're going to be paying as an LP fees to the sponsor. Typically, they charge acquisition fees, management fees, disposition fees. Sometimes there are other performance fees known as a split or a promote, sometimes called. So there are a number of different fees that you're going to pay, because you have to be able to compensate that sponsor for being involved in a day-to-day. There's no such thing as a free lunch. So if that individual is going to be taking all the risk of being the steward of your assets and your investment, they have to be compensated. And so that's a downside, versus if you were to be investing on your own, there would be more work, but you would get all of the benefits of that.
Yeah. Now I'm biased because I've been on both sides of it, but I'm an active investor as a GP in many syndications, but I'm also a passive investor. And as a passive investor, the fees, they don't really bother me because people need to get paid. And some people have a real problem with people getting paid in syndications, but it's no different than any other business, especially the today asset management. And the acquisition fee, there's a lot of work leading up to that moment, just the networking it takes. Some people never get into deals, large size deals, because let's face facts, it's not easy to establish that broker relationship who's going to say, hey, Mark, we have this deal. It's a pocket listing. It's not like you're going on the MLS and finding large deals. It really is kind of a relationship business, and those relationships take a long time to establish. And I think sometimes people forget, oh yeah, that would be pretty hard. That would be like a career in itself, establishing those relationships. Now, there are kind of rules of thumb in terms of fees. And for me, personally, I think 4% total is okay. People say 5%, and that's like 2% for the acquisition fee, 2% for the asset management fee, and then a 1% disposition fee. And we've never had a disposition fee. That means a fee when you sell. So for us, typically it's been roughly 4%. But if you see something where the fees total up to 8% or something outrageous, then yes, that's definitely something worth raising an eyebrow over.
For sure. Yeah. So evaluating those fees, you don't want to shortchange the sponsor. You want to compensate them for all the time and energy that goes into building those relationships. Like you said, looking through potentially hundreds of deals to find one that makes sense, and then doing all the legwork to get to the closing table. That's just the beginning of their efforts, by the way, but that's everything that goes into the acquisition fee. You want to make sure that they're compensated for that. I know that you and I both have had the experience of working in an uncompensated way for sometimes years. It could take a long time ultimately before your sponsor actually makes any kind of real money, which is usually at the refinance or exit. And so that's something you have to keep in mind when you're evaluating some of these fees. Yeah, you may be able to save some of them by doing the work yourself, but how much is your time worth? Do you have expertise in this space, or are you willing to put in the effort to become an expert in real estate? And if the answer is no to any of those, then I would strongly consider a syndication. Which brings me
Yeah.
to the next disadvantage, which is lack of control. Investors basically have no say in the operational decisions or the day-to-day management of a syndication. So when you sign that paperwork, that PPM, subscription agreement, all the docs that go into a syndication, you are basically assigning control to that sponsor to be able to make those day-to-day decisions.
Yeah, absolutely. And I have a lot of investor conversations where I can tell pretty quickly that they don't want to give up control, and that's fine. I totally get it. Like engineers are known for that. There's a lot of IT engineers who do invest in real estate, but they tend to be numbers oriented and they tend to understand the numbers and or want to understand the numbers. So I have a brother, electrical engineer. He'll never invest with me. And that's okay. I get it. He likes to be in control, and it can be, look, hey, let's be real. The last year and a half has been difficult. All is not rosy, people's passive investments, and that goes across all asset classes. I'm not just talking about or real estate, but all kinds of alternative assets, private equity, and you can make your investment and things may not go well, but how much information can you get? How transparent are they going to be with you? And then what kind of plans are they going to put in place to get the ship righted? That's all part of the initial due diligence that you have to do as a passive investor to make sure you are comfortable not having that control.
Absolutely. Yeah, it's a big give up. So for the micromanagers out there or the control freaks out there, it may not be the right move for you to invest in syndication.
You know who you are.
Yeah, exactly, which is probably why we're both in the syndication space. So complexity is the last one. There is a ton of legal and regulatory requirements, or are a lot of requirements that can be complex and costly. I know in our cases, it's cost close to, in some cases, 25,000 to remain compliant. You're issuing securities. So you have to go through a whole process of documentation with a special lawyer, an SEC or syndication attorney, to be able to draft up those docs. And then also you have the tax situation. If you were in a joint venture or maybe you just had your own real estate investment, doing your end of year tax reporting would be relatively easy. But when you have 40, 50 plus investors in a single deal, it becomes very much more complex. And so that comes with costs as well.
Yeah, no doubt. I mean, you pretty much can tell right off the bat. You have to read through a PPM, which is a book on a syndication, whereas with a joint venture, you can draft up a pretty streamlined operating agreement that can be fairly short, 10 pages maybe, whereas pages plus typically for a syndication, mostly due to all the liability and the risks, and there's a lot contained in there.
Yeah, I call
And
that PPM a fear document because it lays out all the things that can go wrong potentially in your real estate investment.
yeah, and I think if you're a trader on E-Trade or Ameritrade or whatever, and you're buying stocks, I'm sure there's a ton of small writing, small print that you never read. But with a private equity investment, you're going to get, full size page document that I mean, it's more than recommended. It just absolutely has to be read through. I mean, I would always suggest read what happens if a deal does go south. What happens in the case of a capital call? Are you obligated to make a contribution to that? Just things like that. There are some sections that are more important than others. You pretty much have to read through all that fun legalese.
Absolutely, yeah. And I, for one, always dread the days. I also invest passively. So for my active as well as passive investments, I dread the days where I have to read through a PPM and then the operating agreement and all of those. You said it could be upwards of 200 pages when it's all added up. It's stuff that you have to know though, because unfortunately, once you wire those funds and sign those docs, you're no longer in control. And so you want to make sure that you know what you're signing up for.
Yeah.
So we're going to move on now to the joint venture section. So we talked a lot about the advantages and disadvantages of syndication, and now Rick is going to take us through the same on joint ventures.
Yeah, joint ventures involve typically two or more parties. It says two or more, but really you kind of want to cap it at no more than four. I don't know if there's any law restricting you, but it just would get too messy the more partners you have. So I would say 2 to 4 or 5 typically, and they all pool their resources. It can be discussed amongst the individuals what percentage each people want to, again, you want to lay out the roles from the top. Anything you want to add to that right there?
Yeah, I think the big distinction there between syndications and joint ventures is that all of those parties, as you said, have an active role and they all share in the management responsibilities of that investment. So, like you said, clearing up or clarifying in the beginning what those roles are. Hey, you're going to be in charge of the construction and you're going to be in charge of whatever financial reporting and so on. We'll make sure that's a successful business. I think there's a stat out there about the number of businesses that fail due to unaligned or misaligned expectations, that different partners have different expectations, and all that stuff could be clarified if you have a solid operating agreement.
Yeah. And from the ease perspective, you have to have an active role. You can't just bring in your uncle who's got a lot of money and he just wants to kick back and watch Monday Night Football and, hey, here's my cash, go do what you want with it. He would have to be active. He would have to be put in charge of some role. So that's something to definitely keep in mind. You can't just have a silent partner contributing money. That's a passive investor, and that's against the rules. So some of the advantages are the flexibility. I think, again, in a syndication, you have the responsibility to a bunch of investors and you lay down the guidelines and you can't just change it up midstream. You have to operate based on the operating agreement and what was in that PPM. Whereas with, let's just take our JV, we can just call a meeting and say, hey, you know, guys, maybe this isn't the way we initially anticipated in this one area or whatever. What should we do? Maybe we should just revise this. There's absolute flexibility. We can just set up that call, no problem. There's only 4 of us or however many you may have. And then in terms of act involvement, I think, okay, so each partner has a say in management and operational decisions. Again, you might have louder voices than others, but everybody's got to speak up and be involved in one way, shape, or another. Shared expertise. That's another advantage of joint ventures. I think it's important for people to kind of take a step back and see, like, what is their skill set? What are they going to contribute to this partnership? You know, are you a numbers person? If there's a need for marketing, maybe you're a marketing person. Are you an asset manager? Do you have the legal background? Anything that can bring something to the table, that's important, kind of looking across at your partners. And also you got to get along. I think that goes with either, really, actually. But if you are going to be a joint venture, it almost has to kind of border friendship. Like we're in this together kind of thing. Anything more you'd like to add to that, Mark?
No, I think you hit on all the major points of joint venture. I think the key for me is there's less involved as well with a joint venture than there is with a syndication. You're not going to have to report to investors on a regular recurring basis. You're not going to have as complex of tax reporting. There are some cases where you've got to make some tough decisions with a joint venture or with a syndication. But in the case of a joint venture, you're not as tied to what is the immediate return. You can make some decisions to defer some of those, like cash flow, for example. Whereas with syndications, I think people expect a certain level of return, financial return in the short term, as opposed to a joint venture where you can maybe think about on a longer term basis and make decisions that way. That for me is a really big distinction because real estate is long term. Sometimes you see people get into trouble with syndications because they've made certain decisions on a short term basis that don't always pan out long term.
Yeah, you essentially have to report on a monthly basis for your syndication, that is, and yeah, it's a published report. You generally share the property management's financials, which is most people don't go through those. They actually don't really tell the full story. They can be a bit misleading, but they're long, and unless you love accounting or whatever, most people aren't going to go through there. So you kind of want to summarize in a nice graphically presented way what's going on with the property, how it's performing, with the CapEx plan. How are you from budgeted to actuals? People want to know that. And then what's going on with their distributions. With a joint venture, it's essentially, yeah, you get your property management reports. And you definitely need to take a look at the numbers from time to time. There's a dip in the numbers. You want to find out why. So in that regard, maybe it doesn't have that built-in organization that you have to have for a syndication. You just couldn't get away with that in a syndication, letting something slide by. So I guess it's kind of how organized do you want to be with a joint venture? You have that flexibility. You don't want to be too disorganized. But moving on, so we could talk about some of the disadvantages of joint ventures. First one, potential conflicts. Again, this kind of goes back to how are those relationships? Differences in opinions and management styles can lead to disputes. So in terms of personality, the personalities have to mesh and skill sets have to complement each other. Otherwise, I don't know if you've ever been in a situation where you've considered a partnership and then saw something, saw a red flag, thought, oh yeah, that's not going to work probably. Have you ever been in that kind of situation?
Oh yeah, absolutely. Fortunately, I've learned over the years of investing and being involved with different partnerships, what are the things to kind of look for. And now I have a very defined set of criteria. I have a questionnaire actually that I always ask people. I think today vetting of partnerships is very different than it might have looked. And so I would say if you're looking to enter a partnership, probably talk to somebody who's been through a bunch of them and ask them what they would do. I know a book that I read a number of years back was, I think it was called The Partnership Charter or The Partner Charter. Would highly recommend that one, or reach out to me and I'm happy to share my questionnaire with folks about the questions that I ask a potential prospective partner, because these are long-term, like I was saying before, these are long-term investments. So you're getting into bed with somebody for a long period of time. And so you want to make sure that you know who this person is and how they make decisions.
Yeah, yeah. And that's the old saying, you don't know what you don't know. If you haven't been through it, you'll get to something. If you just kind of wing it, you'll get to something. And that's this experience, right? That's on the job experience. You'll find out, uh-oh, didn't think about that going into the deal. So that's cool. The book recommendation, that's a nice tip. Let's see, moving on here. We kind of talked about this complexity in agreements, requires careful drafting of partnership agreements to avoid misunderstandings. Yeah, I would agree with that. It's not complex in the sense of like a syndication in terms of like some of the documents that we discussed, but you really have to analyze, again, what are people's roles, clearly define those. What happens if somebody wants to get out? What are the exit strategies? And are we all aligned in terms of what we want out of this deal? Are we looking for cash flow? Or are we just looking for a buy and hold that's going to appreciate? And maybe down the road, do we want a 1031? Is everybody on board with that? Or are you going to want to take your money and run? I guess it kind of depends on how well the partnership is getting along and how successful the deal has been.
It's a great point. I also think that, again, this applies to both of them, where I think you need to really read through all those docs, the partnership agreements, and make sure that you understand exactly what's going to happen if certain things transpire. So, obviously it always feels great to get into a deal and see that deal close. But what often people miss is what happens when something goes wrong. If you're in real estate long enough, something will go wrong. You'll encounter issues. And so you've got to be aware of and have that contingency plan in place. And that's spelled out in your operating agreements.
Absolutely. And then the last disadvantage is a biggie, liability. As a passive investor, that you're limited to your investment. What that means is the worst case scenario is you could lose your money. That stinks. But what's even worse is getting sued or getting taken down personally, somebody coming after your home. When you sign on loan as a joint venture, you're personally responsible, right? You're a guarantor on that loan. And it's what's the term, the full recourse, right? Whereas large deals, actually in syndication, even if they're large enough and they're with agency debt, they can be non-recourse. But generally speaking, if you're going to do a joint venture, I think in most cases it's going to be recourse, meaning you're going to be responsible for whatever happens. Your tenant slips and breaks her hip, she can come after you, kind of thing.
Yeah, that's a great point. The liability definitely changes based on the deal size and some of the loan docs and things like that, the types of loans that you do, I should say. So that's something to be aware of. Now, we've covered both syndications and joint ventures. We've dove into some of the advantages and disadvantages. Now we're going to kind of close things out by just talking about at a high level some of the differences. In conclusion, basically syndications are ideal for investors seeking passive income and who prefer to leave the management of the asset to professionals. It can be a really great way, like I was saying before, for people to get started with investing in larger deals and learn along the way. Whereas joint ventures are more suited towards active investors. They want to actively be involved or manage the project and collaborate with other investors. But the key there is, are you looking to be passive? Are you looking to be active? And then kind of you can proceed accordingly. The choice between them depends on your investment goals, obviously, as well as the involvement level and the risk tolerance that you have. So that's kind of our deep dive into this topic of what is a joint venture versus a syndication. Definitely talk to an attorney before you embark on any of this. Make sure that you understand what the rules are around each, especially on the syndication side. You're now treading into, as Rick mentioned earlier, that's the world of the SEC, which if you want to cause a lot of stress for yourself, I would say create problems with any three-letter acronym governmental agency, the IRS, the DEA, the SEC, any of those agencies, you want to really pull your hair out, it's best with those folks. And so you want to tread lightly when it comes to that. Always seek qualified guidance when it comes to forming partnerships. We've shared some of our experiences as far as both goes. We have experience in both. But is there anything that you wanted to say to close out, Rick?
Well, I just want to add one thing that maybe we didn't talk about. You know, as a passive investor, you could put 50 grand into a deal, 100 grand into a deal. As a joint venture member, you could put 50 grand into a deal. You could put 100 grand into a deal. One advantage of being a passive investor is you don't have to deal with the bank. It's true, it's for accredited investors only. You're going to have to verify that you're accredited, but there's a lot of deals out there that are for sophisticated, non-accredited. Whereas with a joint venture, you're going to have to be dealing directly with the bank. So you're going to have to get qualified. It's not quite like getting for a home. They really look at the business of the property more so than your personal income, but they do look at your personal income. So there's a limit to how debt to income you can have. So that is one advantage of being a passive investor. Yes, these are large sums of money, large sums of capital that you're deploying, but at least you're not having to go to the bank. So there's no real cap on how much you can invest. That was just something that I wanted to touch on before we wrapped up here.
Yeah, for sure. No, that's a great little tidbit for folks who are getting involved with this. You may want to consider what are the ramifications of both from a debt perspective, because I can tell you firsthand on the syndication side, we were able to secure agency financing, and that's a very different story than with a local bank or a credit union or something like that in terms of their vetting, how involved they are, but also some of the qualifications that you have to meet as an investor, as the GP of the deal. So that's all stuff you want to keep in mind. But this has been good. Thank you again, Rick, for joining us. Your experiences as in the last cycle has been really helpful in terms of me learning from others. And I know I've really enjoyed our partnership along the way. And so that's been a great joint venture. And I look forward to future partnerships with you. For folks who want to reach out to Rick, where can they find you?
I'll probably just find me on my website at well, my email is rick@fortressfederation.com, but go to fortressfederation.com. and you can find out anything you want, our business and what we're up to.
For sure. Yeah, Rick is a powerhouse in the game. He's got a lot of experience, got a lot of investments. So definitely reach out to him if you have any questions about syndications or looking to get started. This has been it. So I'll sign off as I always do. Folks, be kind, be charitable, and invest wisely. Thanks all.